Compounding is one of the most discussed concepts in personal finance, and one of the least understood. Not because the definition is complicated, because the actual mechanism, the way it operates mathematically, produces outcomes that are genuinely counterintuitive until the numbers are examined directly. Most people understand compounding as growth on growth, returns earning returns, the portfolio getting bigger because the bigger portfolio generates more dollars, even at the same percentage. That's accurate, but it misses the structural property that makes compounding so powerful and so dependent on specific conditions to work. The mechanism works like this. A portfolio generates a return. That return is added to the principal. The following period's return is calculated on the larger base, which produces a larger absolute return, which is added to an even larger base, which generates an even larger return. Simple in concept, but the output is not linear. It's exponential. And exponential growth has a specific property that makes it behave very differently from linear growth over time. The growth in early periods is small, almost invisible relative to the final outcome. The growth in later periods is large, dramatically disproportionate to the early periods. The same percentage return, applied to a base that is compounded for decades, produces a dollar amount that dwarfs what the same percentage produced in the early years. This is why the last 10 years of a long holding period typically generate more absolute growth than the first 20 years. Not because the return rate changed, because the base is so much larger by the time the final decade arrives. A portfolio that is compounded for 20 years generates annual dollar returns that exceed what the entire first 10 years produced. The mechanism rewards patience, not through a fixed percentage on a fixed base, but through an accelerating return on an accelerating base. And the acceleration is invisible in the early years, which is exactly when most investors make the decisions that interrupt it. The second structural property is that compounding is not forgiving of interruption. A year missed is not simply a year's return lost. It's a year in which the base didn't grow to the level it would have reached, which means the following year's return, calculated on a smaller base, is smaller than it would have been, which means the year after that is also slightly smaller, and the year after that. A single year of missed compounding creates a permanent gap, not just for that year, but for every subsequent year of the entire remaining holding period. The gap compounds forward, just like the returns would have. Understanding this mechanism clearly changes how investment decisions get evaluated. A pause that feels temporary, a period of sitting in cash, a year of not contributing, isn't simply a pause. It's a permanent reduction in the compounding base from that point forward. A withdrawal that feels minor, a portion of the portfolio liquidated for a short-term need, isn't just a reduction in the current balance. It's the removal of capital that would have compounded for the entire remaining holding period. The actual cost of that withdrawal isn't what was taken out. It's what that amount would have become by the end of the holding period, which, in a long-term portfolio, can be a multiple of the original amount withdrawn. Compounding is not forgiving, but it's not punitive either. It simply does what it does, consistently, without judgment, for as long as it's allowed to operate without interruption. Most content talks at you. This one sits with you. If that difference stood out, if this felt real instead of loud, like the video, subscribe. This channel is built for people who notice patterns. Most investors focus on return rate. What percentage can I earn? Which fund performs best? Which asset class generates the highest return? These are real questions. Return rate matters. But the evidence on what actually determines long-term portfolio outcomes points consistently at a different variable. Time. Not return rate. Time. The relationship between time and compounding produces outcomes that feel wrong until they're examined directly. Consider two investors, same starting amount, same return rate. One starts at 25, one starts at 35. 10 years apart, same strategy, same rate of return. At retirement, the investor who started at 25 doesn't have 10 years more return than the investor who started at 35. They have significantly more. Because those extra 10 years weren't just 10 years of return. They were 10 years of base building, 10 years of the compounding mechanism operating on the early capital, which then generated returns on the expanded base for every subsequent year. The 10-year head start doesn't produce a 10-year advantage. It produces an advantage that grows with each passing year. The intuition failure here is significant. Most people think about the cost of starting late in terms of missed returns. I missed 5 years, so I'm missing 5 years of returns, which I can make up by saving more or by taking more risk to earn a higher return. That math is wrong. The cost of starting late isn't the returns missed. It's the compounding base that would have built on those returns for the entire remaining holding period. 5 years of missed compounding at the start produces a gap that widens with every subsequent year. Not a fixed gap, a growing gap. Because the base that would have existed would have generated larger and larger returns in each subsequent year, and those returns would have compounded. And the gap between the two positions keeps expanding until retirement. Return rate matters, but it's less powerful than most investors believe relative to time. A higher return rate can partially compensate for starting later, but the compensation is imperfect and requires taking on risk that the longer time horizon would have made unnecessary. The investor who starts early at a moderate return often ends in a better position than the investor who starts late and reaches for higher returns to compensate. Because the early investor's compounding is operating on a base that has had years to develop, while the late investor's higher return is operating on a base that hasn't had the same time to build. The time variable can't be fully compensated for by the return rate variable. This is why financial advice that focuses primarily on return selection, which fund, which strategy, which allocation, misses the most important lever available to most investors. Starting. Not starting with more. Not starting with a better strategy. Starting. As early as possible, with whatever is available, and allowing the time variable, the most powerful variable in the equation, to do what it does over the holding period. The difference between starting at 25 and starting at 35 cannot be fully recovered by optimizing anything else in the investment equation. Time is irreplaceable, and the investors who understand that treat starting as the most urgent decision, not the most deferred one. Compounding is a mechanism, not a philosophy, not a strategy. A mathematical mechanism that operates according to specific rules and produces specific outcomes when those rules are honored or violated. The most important rule is consistency. The mechanism works because returns are added to the base, and the next period's returns are calculated on the larger base. Anything that removes capital from the base or interrupts the process of adding returns to it breaks the mechanism. Not permanently, but consequentially. Panic selling is the most visible interruption. Markets decline. The portfolio loses value. The investor, reacting to the loss, sells to stop further damage. And in doing so, they interrupt the compounding mechanism at the worst possible moment. Not because selling during a decline is irrational, In isolation, it seems like prudent risk management. But because selling during a decline locks in a loss on a smaller base and exits the position before the recovery occurs. The investor who sold has to be right twice about when to exit and about when to re-enter to avoid ending up worse than if they had simply held. And the evidence on investors who panic sell and then wait for the right moment to re-enter consistently shows that they re-enter late, after significant recovery has already occurred, and they've missed the rebound on a base that is now smaller than it would have been. Fee drag is a less visible interruption but equally consequential over time. A fee taken each year isn't simply a reduction in that year's return. It's a removal of capital from the compounding base, capital that would have compounded for every remaining year of the holding period. A 1% annual fee on a portfolio held for 30 years doesn't cost 1% times 30. It costs the compounded value of that 1% removed every year over the entire 30-year period, which, at typical market return rates, can represent a significant portion of the total portfolio value at the end of the holding period. The fee doesn't reduce the portfolio linearly. It reduces the portfolio's compounding potential, which compounds forward from the moment of the fee for the entire remaining holding period. Withdrawals follow the same logic. Capital removed from a compounding portfolio isn't just the amount removed. It's the compounded value of that amount over the remaining holding period. A withdrawal of $10,000 from a portfolio with 20 years remaining at typical return rates doesn't cost $10,000. It costs what $10,000 would have become over 20 years of continued compounding, which can be a multiple of the original amount, depending on the return rate and the remaining time horizon. This doesn't mean withdrawals are never appropriate, but it means the true cost of removing capital from a compounding position is almost always larger than the amount removed. The structural conclusion is simple. Compounding rewards consistency and penalizes interruption, with a cost that compounds forward from the moment the interruption occurs. Every decision that removes capital from the base, every year of missed contribution, every panic sale, every fee paid to active management, every withdrawal made before the holding period ends, carries a cost larger than it appears. Because the cost isn't just the immediate amount, it's what that amount would have compounded into for every remaining year the position would have held. The mechanism is not complicated. It just requires being left alone, consistently, without interruption, long enough to produce what it was always capable of producing. If this shifted something for you, subscribe. Like this if it clarified something.